the volatility lags a little bit, and I think that clock is ticking. Potentially, we could see volatility reemerge in terms of being a lot higher. 3 cuts in interest rates would substantially change interest payments relative to GDP. In today's environment, the US is basically running the largest interest payment relative to GDP of any country in the world today. We have the debt problem of the 40s, the inflation of the 70s, and now a valuation problem of companies like we saw back in the tech bubble. I am a firm believer that this is not a really good environment for the dollar. There is a potential that emerging markets and emerging market currencies could do much better than developed markets because of this setup for commodities.
Hi everyone, Daniela Cambone here. Hope everyone is enjoying the summer series and your summer overall. I know it's the time that we're supposed to be kicking back and relaxing, but important that we don't become complacent. And if you do not have a financial strategy in place, I strongly urge you to contact us. Book a Calendly appointment. We will offer you and give you a free information session. All you have to do is click on the link below in the description of the videos and choose a time and day that suits you best. And one of us here at ITM Trading will reach out to you and help you build a surefire, foolproof wealth preservation strategy. I strongly urge you to do that. Now check out today's video. Hi, this is Daniela Cambone and welcome back to the summer series here on ITM Trading and the Daniela Cambone Show. And joining me today is Tavi Costa. He's a partner and macro strategist for Crescat Capital. His research, his phenomenal research, has been featured multiple times in Bloomberg, Wall Street Journal, Financial Post, Globe and Mail. The list goes on. Tavi, always good to be with you. Thanks for catching up with me. I know the summer is crazy with travel, so thank you for making the time.
It's my pleasure. It's always great talking to you, so thanks for having me.
Yeah, and we're catching up right after the latest CPI data here, and I want to talk about that because you say we are really experiencing a macro regime shift. So let me outline everything that you say we're living with right now. Interest rates have bottomed out. Commodities have ended a long period of decline. Deglobalization has escalated. Central banks are rushing into gold. We see safe havens such as the Japanese yen losing power, collapsing. Political populism has emerged and inequality issues have worsened. I know you added there that inflation has resurged. Are you a little optimistic given the latest data that we're seeing?
My views on inflation are very, very much in the long term and not over a report versus another report on a monthly basis. But I do think that we're still having inflation extremely entrenched. I mean, if you just look at oil prices, energy prices especially are up, I think it was 15% year over year still. So there is still a lot of things in the pipeline that could potentially change the inflation data. The relevance of what's happening, however, today is that we're starting to see some cracks in labor markets, cracks in the economy that I think is forcing the hands of the Fed. And as we see that occurring with inflation still higher than historical standards or higher than where they would like to be, is such an important aspect. It's just a supercharged environment we tend to have when central banks have to basically force financial repression in a period where inflation still is substantially higher. And so I think that that's really the big problem occurring. And what fascinates me is that markets don't change all at once. It's sort of all these things are kind of infiltrating the system over time. And so we're seeing all these small changes. They're very significant, but they're, in a way, they kind of look like single or individual events, but they're all linked. And there are a few things that are which I would call dominoes to fall that haven't yet to fall. And I'll give you an example: volatility. You have rates going up. We were in an era of easy money and low interest rates, near zero interest rates for a while. Actually, near zero. that suppressed volatility for a long time. Markets actually are able to go a lot higher. We've had other experts like Jim Chanos called this the era of frauds. There's so many different things, but interest rates are not in that environment any longer. I mean, we're much higher than where we were. I mean, talking one cut or two cuts, it won't change the picture. And so it's important to note that the volatility lags a little bit. And I think that clock is ticking, and potentially we could see volatility reemerge in terms of being a lot higher and sort of reflect this reality of rates being a lot higher and the risk being a lot higher, which I think it's just not reflected in this environment just yet.
So good point. You say even if they do start cutting a little bit, it won't make a difference. But why don't you think they'd get aggressive with the cuts?
Oh, I do think they will. And I've been, I wasn't of that view when we had 7 cuts priced into the curve. And now when we went from 7 to 2 or 7 to 1 at some point, certainly I shifted my opinion. I think that's how market participants should behave. I looked at the 2-year yield, for instance, just as an example of looking at the short end of the curve and how markets are pricing in the potential for the Fed changing rates. And at 4.5% or so, and I look at that long-term chart of 2-year yields, and we've been bumping that resistance throughout. Every single time we hit close to a peak of the market, we hit it to a historical resistance. And then recently, 2-year yields basically broke out. And went all the way to 4.5%. People were scratching their heads. What happened? Well, that's the macro regime change. We're in a different environment now. Now, even though I have that view, I do think we're going to retest that resistance that now became a support. And so 2-year yields could easily go back to 2%. It could, and I can definitely see multiple cuts here, especially coming on the back of a much worse Fed or economy that could, a contraction that could force the Fed's hand. And another thing that is very, very important here, 3 cuts in interest rates would substantially change interest payments relative to GDP. In today's environment, the U.S. is basically running the largest interest payment relative to GDP of any country in the world today. How long can we continue to do this? I mean, people call the fiscal dominance. I agree with that, but it's not fiscal dominance globally. We're really seeing this in the U.S. versus other places. No kidding, we have growth in the U.S. It's because we're spending too much. And so I don't know if this is really sustainable. In my view, obviously I have a view, so I don't think this is sustainable at all. So I think the mandate of the Fed is going to go back to maybe we got to cut rates to allow the government to pay its bills.
A really solid point, and I'm happy you brought up the GDP because I just came back from Rick Rule's show, and I love it because there were people with very differing opinions. I was kind of surprised of how so many are kind of dismissing this, what I see as an unsustainable trajectory of U.S. debt and fiscal policy, Tavi. And I think you agree that the debt ceiling presents a much greater risk than currently perceived, correct?
Yeah, well, it's a big problem because we've seen this sort of long-term issue being pushed forward so many times that we think it's not a real problem. However, the flood of issuances of treasuries that we're seeing is a significant issue. And to me, that sets the stage for a macro trade, which is the steepening of the yield curve. I think there's a lot more to go in the steepening of the yield curve because of what you just said. The flood of issuances that has happened on the long end of the curve, forcing central banks actually to not be able to really enable them to buy as much as they used to of treasuries on the long end relative to the issuances is a huge point. We're seeing a decreasing demand on a relative basis of supply. And when you look at the debt, the federal debt, we can break it down into 3 parts of the debt. There's the short-term issuances, there's medium-term issuances, and there's also long end. And basically, majority of the debt is in the middle part. I think we're going to flip back into the short end of the curve because that's where the Fed can manipulate the cost of debt, essentially. And as we see that occurring, I think it's going to allow the 10-year yields and long end yields to actually move a little higher. So, I can see a world where the steepening of the yield curve abruptly changes to the upside. And be very careful here, because there's going to be a lot of analysts that will look at the steepening of the yield curve and will say that's actually very positive for the economy. That shows growth. That is not positive when you're coming back from a deeply inverted yield curve, one of the longest periods of, if not the longest, of yield curve inversion in history. And we're actually steepening or uninverting to more sustainable levels. As we see that occurring, that's a very clear recession sign. You can plug in so many charts: yield curve versus unemployment rates, initial jobless claims, continuing jobless claims. You can see that clearly the steepening of the yield curve from inverted levels is a very negative signal to the economy. So I think that's one of the most important traits we have at Crescat as well, which is the idea that we're going to see a significant steepening of the curve here moving forward.
As you said, a major recessionary signal for you. So two questions. And tying this into your point about major cracks in the economy, are we talking the wheels completely falling off or something repairable?
I think the Fed is always going to step in and either expand the monetary base, or some others call print money. And it's really interesting that we're seeing one of the sort of tightest hiking cycles we've had in history in the last year or so. And still we have money supply growing. We saw monetary base growing substantially. And so it's like the Fed is doing QE in some way, not QE technically because they're not buying bonds, but essentially expending liquidity without calling it that they're doing something along those lines. And so they're almost like doing things underneath the surface of a lot of folks that tend to follow the economy. And so clearly there is a much bigger type of I guess role of the Federal Reserve trying to avoid increasing volatility and other issues. I mean, I truly believe that what we're facing today is I mean, we can say unprecedented as a big word, but it is really, because we have the debt problem of the 40s, the inflation of the 70s, and now a valuation problem of companies like we saw back in the tech bubble. So, how will policymakers behave? Ultimately, we go back to either some measurement of yield curve control to allow the government to really, restore this leverage problem that they have. I mean, every debt that is in the system has been transferred to basically the government. The government's running the big balance sheet here right now. And so how do we sustainably keep that going? Inflation is going to have to be part of the picture. And I think also some sort of financial repression, which ties very well with the commodities idea. That's what supercharges the commodities market, which has been neglected for so long. And then I looked at things like the mining industries, and I looked at how they are been lagging, and they have been lagging here recently. I think that's really the major opportunity with this environment.
Yep. I want to talk opportunities, so hold on that, and obviously talk gold and the miners. But getting back to the discussion of how we get out of it, talk to me about the devaluation of the dollar. Is that part of the equation? I mean, we've already seen it devalued over 50% from 2020, but are they going to have to do the same thing that happened post-Vietnam War, Tavi, where we're going to have a major devaluation of the U.S. dollar? And I know you say everyone and their mother is long the U.S. dollar, but what's your take on the dollar theory here?
Oh, well, I do think that the dollar is under. It always is important to notice when you have an asset class that is supposed to be moving higher because of the tailwind on the macro side, and it's not doing so. And what I mean by that is I think we're living in a world today in developed markets that have one of the largest interest rate differentials in history. You have Japan that really cannot follow the path of the Fed to the same degree. You have the Europeans also doing the same with the ECB and others, the UK and others. They're not being able to raise rates as much as the Fed. In fact, they're starting to move the other way already. You have the Bank of Canada. And so I believe that with the interest rates being so different here in the US versus other places, you would suspect that money would be flowing here back and the dollar would be surging, but it's not. And so what if that changes? What if the Fed is now forced to join the party and cut interest rates, what would that do? And now that tailwind becomes a headwind. And so I am a firm believer that this is not a really good environment for the dollar. Now, I'm not here to say that the U.S., that the dollar, it's the end of the dollar or anything along those lines. I do think that there is a potential that emerging markets and emerging market currencies could do much better than developed markets because of this setup for commodities. And so that's a huge part. But going back to your question, how do we get out of this? In the 70s is not a really good, analogy to or analog to this today's situation, because the debt is obviously wasn't as severe as back then. So they could fight inflation by raising interest rates. The 40s would be the best place. And what did they do in the 40s? Well, first of all, they basically did measurements to control yield curve, so they wouldn't allow the long end of the curve to rise significantly. So that would control the debt problem. But the second thing that they did, that not a lot of people talk about it, is they actually had to run a primary budget that was a surplus, meaning what is a primary budget? When you look at the Fed's or the government's spending, you take away how much they spend on paying down the debt to service the debt. And that portion that remains there, in the 40s, we were forced to run a surplus in that front. Today, how do we do that with electrification trends on the onshoring situation with deglobalization? We have military issues that forces military spending. So AI revolution with data centers, people talking about spending trillions and trillions of dollars of infrastructure. We got electrical grids that needs to be all revamped. Manufacturing capabilities, you want to onshore? Boy, we gotta invest a lot more. We haven't done anything yet. And so all those things are going to have to be part of the discussion. I think it's really different than the 40s today. I think that the final resolution for all this is going to have to be inflation. So this is why I'm really sticking with my view that long-term inflation here is going to stay a lot hotter than historical standards. Forget about reports after reports. Remember the waves of inflation. That's likely what's going to be here playing out. And so to me, that's a much bigger deal than paying close attention to the short-term moves and, the Fed will cut rates or not. All these things are going to ultimately create a financial repression that will probably cause real assets to reaccelerate to the upside.
Talk to me about the overvaluation of the S&P. You're saying, with peak levels comparable to 1929. What are people missing?
They're missing a lot of things, complacency, risk. I mean, just looking at the price of the S&P or the Dow Jones or the NASDAQ in gold terms, we're talking levels that we saw back in the peak of 1929. And, it's okay to be there if we're going to have rates at zero. But they are not. And even not only that, the suppression of volatility is a huge thing, as I said before. But also look at, if rates are higher, you would expect that corporates would be also borrowing money at much higher interest rates too. And we haven't seen much of that change yet. And the main reason for that is because we're in the process of those companies starting to roll their debt. It's very important for me, at least, to see, for instance, the bankruptcy filings beginning to rise now, and that's really on the back of the fact that cost of debt is so much higher than it was when those companies levered up at cheap cost of capital. And so clearly, the cost of money is starting to have an impact in the valuation of companies. Ultimately, I would say that we're going to go back to a world where investors pay closer attention to profitability. We're, as I said before, we had a domino fall, a lot of dominoes falling, and one of them that have not fallen yet is, to me, the equity markets, the complacency, the volatility, the risk that is still seen as okay by markets and because of the AI and so forth. And the irony, in my view, of this artificial intelligence issue is how much is going to be needed for infrastructure in order to make that deflationary. It's going to be highly inflationary at first. And so I think all these things need to be balanced in markets relative to growth. And you look at estimates for earnings, they are just way unrealistic in my view for 1, 2, 3 years out. So I really think that the yield curve should be, taken into account here. People should be paying close attention to that. And as we see the yield curve, movement going steepening even further, and estimates at, in wazoo, basically, we're seeing basically the estimates for earnings and fundamentals is in la la land in my view. And so I think ultimately compression of multiples is going to have to be part of this picture. And so, I wouldn't be putting my money into technology and other things that still look really expensive in my view.
How far away are we from that domino falling in your view?
I think we're very close. I'll be shocked if we don't see anything in 6 to 9 months, if not even shorter. Elections is coming up. There's so many uncertainties on how things are going to play out here. You have, in my view, a total lack of discipline by both parties when it comes to the fiscal issue. I believe there's the risk for 10-year yields to rise a lot further depending on who becomes elected, which I'm not sure I really want to get into my views on that because people get very political on these things. But I do see that the lack of discipline, fiscally speaking, is also going to drive the cost of debt a lot higher, especially in the long end of the curve. And I don't know. That seems to be Bank of England was such an important moment in history that we saw back in 2022 when they cut taxes of unfunded liabilities, and you had a huge move of the UK yields basically surged to levels we've never seen historically. I think this is sort of the risk for a lot of developed economies, and the US is not is not immune from that risk either. So I believe that volatility is going to have to follow along. And by the way, if you look at the asset classes, in my career, the only times we've seen this sort of calm before the storm is usually obviously prior to 2007 or 2019 or 1999 and so forth. I mean, every asset class has suppression of volatility, oil, the dollar, the equity markets. And so I think things are starting to move. I mean, watch what's happening with small caps. I mean, small caps are not doing very well. And that's 2/3 of the labor market, if you think about it. So that's the real economy.
Yep, and a huge risk. Talk to me about gold now, Tavi. I mean, look, the price, we're seeing all-time highs. Yet the retail investor has not fully shown up. It has in China, but not North American investors. When do we see the retail rush? Do we?
Well, first of all, I'm not sure the retail disclosely in China is even able to buy gold as much as other places could be just because of the crackdown on those things. However, their central bank is doing so, and other central banks are following the league. I mean, if you're a gold bug, your dream was to see disclosed buying of gold. And finally, we have that here. And still, the skepticism remains in place about the metal. And I think this is playing out just like, we've seen in the past as far as this accumulation of gold relative to the central bank assets is still at the very early stages. They still own less than 20% of their overall central bank assets. And I think that we're going to go to 70, 80% of their assets in gold. And that's because of many reasons, the deglobalization trends that continue to escalate and force countries to own a neutral asset that has history. Really, there isn't no other alternative that falls into the category. You can maybe say Bitcoin, but Bitcoin has no close to the history that we have in gold as serving the society with real money. And so these things are coming back. And I would say that from a retail investor or really from a family office, because retails don't really move the markets as much as two pools of capital. You got central banks that we just talked about, and then we have the other side of it, which is pension funds, 60-40 portfolios, and so forth. And those folks have not moved money into gold yet, and they have a very different way of prioritizing decisions in investments. Central banks tend to make decisions on the risk of losing their assets, such as what happened with the confiscation of the treasury market or the treasuries in Russia recently. Those are bigger questions for central banks, is the stability of their currency and other things. A pension fund have much more of a risk regarding volatility, regarding downside volatility, the risk of markets collapsing, what asset will serve as a defensive asset. And what we're seeing in terms of volatility of treasuries versus gold is such an important thing. I mean, this is the first time in 45 years that gold is less volatile than treasuries. I think that those institutions are going to follow suit with the central banks.
100%, 100%. Like I said, I just got back from a mining show, so curious to get your thoughts, because people are always bearish the juniors, Tavi, but you say the junior miners to gold ratio is showing otherwise. We're closing the gap.
I think I'm alone in this room. It just feels like everybody has given up, and
I hear crickets.
Look, here's what I see that I think it's phenomenally and in terms of an opportunity. And especially when you're looking at private deals. I'm not saying that public deals don't look attractive either, but private deals are interesting because you sort of get the sense of a company that is trying to spin off an asset, and you kind of have a close look of the numbers, obviously, and what you tend to see is the estimates, and I think that is at the core of why general investors are not coming into the space, by the way. So basically, if you look at any company that's being sold today, they make assumptions of cost that we're going to be seeing massive inflation, which, by the way, might be the case. We may see costs, inflated substantially here in terms of the operations and so forth. Now, their other assumption that kind of blows my mind is the fact that they assume, and you can look at this in any deck of basically any of the major companies. I'm not going to call them out, but you can see that they assume deflation in metal prices. I don't know what you think, Danielle, but I don't know. I don't think that we're going to see cost of inflation actually, or inflation costs surging with metal prices falling apart. I think that's to me, it's almost like as close to, in the macro world, we would call this an arbitrage. And so to me, if businesses are going to be valued in that way, I want to buy them. I want to look for partners that I can raise money and purchase all these companies that are being sold with multiples at highly depressed levels that nobody wants to look at them. We all want to talk about, we want to be great negotiators and business people and so forth, but what we need to do is allow the market negotiate for us. The market has already negotiated for us. I mean, if you look at the technology space, for instance, just for a drastic comparison here, cost for most of the companies in terms of estimates are all falling apart, and the revenues estimates of those businesses is surging in terms of what they expect. And so that is a complete opposite environment that we have here. This overly conservatism, to me, is a sign of the opportunity. I don't know if it turns next week, this month, or so forth, but Senzel once said, great money is made on lack of capital interest and not the other way around. And I think this is a classic example of that. And so I'm paying close attention to this. I think we're going to break out on the mining to gold ratio. I think we're already did actually, but I think we're just going to create a lot more momentum, and things are going to change.
And not to we could have a whole 1 hour discussion on the state of the junior miners, but I think some of the feedback I was hearing from the show is that, okay, yes, the price is great, everything should be, this is a ripe time for the juniors to shine, but problems persist, such as, is there the technical man and woman power to operate these projects? Is there a lack of talent to bring it forward?
It's a huge problem. We have a vision, and I can't talk much about this yet, but there's a vision we are trying to implement to bring folks to the School of Mines here in Colorado. It's going to be a very interesting way to try to tackle this issue. I think the lack of geologists and geosciences and interest in the space is a real structural problem in this industry, but also an opportunity. And what we're going to see is that the lack of supply of those experts to run these businesses is the main reason why there's so many inefficiencies. We have a private business that we run, And what is interesting is I don't see this in many other places when you can spend 10, $20 million to then make $100 million on efficiency. No, most other businesses are efficiently run already. And so these are the types of changes one can apply if he is with the right folks working with. And I think we got to do better as an industry. And there's so much to be doing here. I mean, this is the type of stuff that gets me up at night, up in the morning, because I think that's the real opportunity. The lack of young folks entering this industry is a main reason why prices are so depressed too. And I think this is going to change. And so I can't share much of my vision, but
I had no idea. I brought that up, and I had no idea that you were working on that. So that's very cool. And when my nieces and nephews ask me, what should I go into? And I'm always like, go into mining. The opportunity is huge. There's opportunity to make really good money, travel the world. Anywho. Okay, one last point. Gold silver ratio, talking about ratios coming down. We're closing in here. Your thoughts on silver, Tavi?
I think I'm one of the biggest bulls on silver out there, and I will continue to be so because I've never seen a bull market in gold that is not led by silver. And most people are saying that. And the same thing with the miners, by the way. It's like people are just stuck with this view that it's a false narrative that is completely unsupported by history, that you will see gold prices surge, no other metals will surge either, and we're probably not going to see miners doing very well. This is just crazy. It's just ludicrous to see this type of narrative imposed by market participants that have basically never really lived through a bull market in the space. And so I think this is the silver market remains not only one of the best ways to implement this idea of being in a bull market for gold, but also to me is going to play a critical role here in terms of the not only this electrification environment, the solar panels. I mean, just looking at one thing, for instance, the solar panels demand is running close to 15% now in terms of the supply of silver. It used to be less than 5% not too long ago. I mean, you can see these changes happening. This is just one thing. I mean, what about if we start seeing large institutions buying silver because they believe in gold, retail investors? And I think we're starting to see that. I think a lot of people would be shocked to see silver being sort of almost, I would say it's extremely undervalued at $30 an ounce. I can easily see this at triple digits. And I'm not claiming we will, but I really think we will personally. And if we do, I think a lot of businesses have a tremendous amount of leverage in terms of generation of free cash flow. If we do see metal prices follow those types of kind of price levels, which I think is very realistic in my view.
Tavi, like I said at the start, you're one of the brightest minds in this sector, and thank you for giving us really, a macroeconomic perspective on everything happening. I guess just to wrap everything you've said, obviously you're bullish the commodity space, particularly gold. I know you have young children at home, as do I. Are you concerned for your kids and what they'll face?
That's a doom and gloom question, Danielle. But no, I think we're gonna be. I think we have to stick with our principles. Principles of parenting and principles in general of I'm a Christian, so I don't think the world is going to change in that manner. I think we as parents have an incredible opportunity to make this new generation a great place for the world, and I'm certainly going to work hard on that with my. I have one kid, but hopefully I will have more kids. And the point you talked about this I think mining, for instance, and other industries have been sort of neglected for so long now. It used to be critical. We need this kind of generation step in and start seeing the opportunity that we could potentially have. And I think those industries will serve great to society over the years. And to your question, I'm not concerned at all. I mean, obviously the issues we have with AI and other things are concerning, and of course I think about those things. But I'm not a doom and gloom. I'm extremely optimistic, and I'm sure we've been through so many issues in history: World War II, World War I, Can we see another war or something along those lines? Of course. I mean, that's, let's not be naive. I mean, things are definitely escalating, but I also believe in ingenuity, and also believe that we're going to be able to find solutions over time. So I'm extremely optimistic, and I'm very hopeful that things will work out just fine.
On that note, Tavi Costa, I wish you a good rest of your summer. We'll catch up with you for sure in the fall. I really appreciate your insights today. Thank you.
It's my pleasure. Always great talking to you. Thank you.
Thank you, Tavi Costa, and thank you all for watching. We'll have more incredible guests coming your way, so be sure to keep watching the summer series here on ITM Trading on the Daniela Cambone Show, and you can sign up so you're on top of it all at danielacambone.com. Thanks for watching.